All right, let's talk about something you've probably seen, something that seems almost too good to be true, leveraged ETFs. We're going to pull back the curtain on these things and look at the hidden math that can either make you a fortune or, well, much more likely, just quietly bleed your account dry.
I mean, just think about that for a second. What if you could get 3 times the market's returns every single day? It sounds like a cheat code for Wall Street, right? The ultimate fantasy. And honestly, for a little while, it can feel exactly like that.
And here's the proof. Take a look at this number. In 2017, the TQQQ, which is a super popular 3x leveraged ETF, it returned a staggering 118%. No, that is not a typo. It made the Nasdaq's already amazing performance that year look like loose change. So, what's the catch? There has to be a catch, right?
Okay, so first, let's get into the promise. Products like TQQQ are built to give you 3 times the daily performance of an index, in this case, the Nasdaq 100. And this leads pretty much everyone to make a very logical and, as it turns out, a very, very wrong assumption.
And this right here is the siren song that pulls investors in. The logic feels completely solid, doesn't it? If the index has a great year and goes up 30%, I should get about 90%. Simple. Makes sense. But it's also completely, fundamentally wrong.
The whole secret, the entire trap, is hidden in plain sight. It's right there in the fund's own description. And the key word is daily. That one little 5-letter word changes everything. You could make the case that it's the single most expensive word in all of finance, because misunderstanding it is what creates the whole trap.
So what does this daily reset actually do? Well, every single day, when the market closes, the fund has to rebalance itself. It has to buy or sell assets to make absolutely sure it's set up to deliver exactly 3x the index's return for the next day. And this constant shuffling has a huge and usually negative side effect.
And this side effect, it has a name. It's called beta slippage, or sometimes volatility decay. And look at the wording here, a structural drag. This is not a mistake or a bug in the system. No, it's a core feature. It's how these things are built. And in any market that goes up and down, a normal market, this decay just eats away at your money.
This shows the problem perfectly. So, when the index goes up, the fund has to go out and buy more of it at that new, higher price to stay leveraged up. But when the index falls, it's forced to sell at that new, lower price to dial back the risk. I mean, think about that. It is a guaranteed, built-in system of buying high and selling low over and over again.
Now, I know this can all sound a bit abstract, so let's just make it real. Let's walk through a super simple 2-day example. This is where you see the trap in action and you realize, wow, it's just baked right into the math. There's no escaping it. Okay, the setup couldn't be easier. We've got our index, let's call it the Nasdaq, and we have our 3x ETF, the TQQQ. We'll say they both start with a nice round value of $100. Simple enough? So on day 1, we get some fantastic news. The market rips higher and the index jumps up by 10%. If you're holding that leveraged ETF, this is exactly what you signed up for. You're thrilled. And would you look at that? The results are awesome. The index is at $110, but your TQQQ is already at $130. You just made 30% in a day. The system works, you're a genius, but let's see what happens next.
On day 2, the market gives it all back. The party's over. Now for the index to go from $110 all the way back down to its starting point of $100, it has to drop by about 9.09%. So after 2 days of trading, the index is totally flat, break even, right back where it started.
And here it is, the moment the trap springs. The index is sitting right back at $100, a 0% return. But look at the TQQQ. It's not at $100, it's at $94.55. You've actually lost money, even though the thing you were tracking went absolutely nowhere. Just let that sink in for a second. The index gave you a 0% return, and somehow that turned into a 5.5% loss for you. That's not just bad luck. That is beta slippage. It's the unavoidable mathematical price you pay for daily rebalancing in a market that, moves.
So what this proves is that the path the market takes is everything. It's not just about where it starts and where it finishes, it's all about the journey in between. Let's look at a couple of real-world years that show this perfectly. So back in 2017, the market was just a beautiful, steady, low-volatility freight train going up. The QQQ, which tracks the Nasdaq, gained about 31.5%. Now, simple math says TQQQ should have been around 95%, but it actually did way better, gaining 118%.
In that very rare specific environment, the daily compounding actually worked for it. And this is the kind of year that creates true believers.
But then you get a year like 2022, the reckoning. The QQQ fell 33%. A 3x loss from that would be, well, basically a total wipeout at minus 99%. TQQQ only lost 80%. But the real killer was the volatility. The huge up and down swings every day just turbocharged the beta slippage, making any kind of recovery a mathematical nightmare.
And of course, this is where our own brains start to work against us. We're all taught to buy and hold, right? So we see TQQ crash and we think, oh, it's on sale, it's cheap. That's anchoring bias. We refuse to sell because we hate locking in a loss. That's loss aversion. But the brutal truth is, even if the NASDAQ roars back to its all-time high, your TQQ position could still be down 40, maybe 50% or more. It becomes a zombie in your portfolio.
So, what's the big takeaway here? It's pretty simple, actually. We have to completely change how we think about these things. They are not long-term investments. They're not. They are powerful, highly specialized tools meant for very, very short-term trading.
Here's maybe the best way to think about it. For the privilege of getting that 3x leverage every day, you are paying a volatility tax. The more the market bounces around, up and down, the higher that tax is. And it gets paid directly from your investment.
And we'll just end on this. This is the golden rule, the final test. If you can't, right now, explain the simple math of that 2-day example we just walked through, you really have no business holding one of these things for more than a single day. These were made for pro traders with very specific short-term goals, not for your retirement account. The real question isn't whether you can get rich quick, it's whether you truly understand the price you're paying just to try.